A number of Canadian REITs will report this week, and we're looking ahead and asking the question, what will those earnings say about any trends that are materializing? Jeff Olin is with us now, CEO of Vision Capital, player in this space. Jeff, always good to have you with us. And I did want to start right there. We're going to hear from a number of REITs across sections, so we'll get a lens on different kind of types of REIT. Big picture, are you looking for anything different? Are you looking to sort of see trends in the earnings reports?
You know, I don't think you're going to see a lot of trends in this quarter's earnings reports. I think a lot of them are going to be challenged, but I think what investors are looking for is they're looking forward. Real estate is a longer-term investment, and certainly an investor's outlook should be in that vein. And so even in some of the REITs that have reported in both the United States and Canada, that frankly produced ugly numbers, missed their consensus numbers by a wide margin. What investors looked to was the most recent trends, have occupancy stable in some of the apartment REITs. And even on those, so that's on the positive, and it works both ways. You're going to see, for example, on office, some of the office REITs are going to present good numbers, even though we think the disclosure is kind of poor and you're not necessarily going to see the real factors going out there. But does that mean that 12 months from now that the fortunes of the office REITs are going to be as solid as they were 12 months ago? And so we don't see a lot of telltale signs coming this quarter from the REITs that are announcing. We think there's going to be winners and losers in this space.
Okay, let's drill down into some of them. We were just talking about the housing markets, including Greg was just touching on the rental space and condos. Tricon gets you what? When we hear from Tricon, what do you have exposure to, and what do you think it'll be telling the market?
Tricon's going to report good results. I mean, this is, if you want to talk about winners, there's arguably no better winner than the single-family rental residential space. These are homes in the Sun Belt between 1,100 and 1,800 square feet. They rent between $1,200 and $1,900 a month rent. So lower rent per square foot than an apartment. You get a backyard, you get a garage, a driveway. It's typically families that choose to locate there based on a local school district. Now, these were in place before the pandemic, but to the heart of your question, this is a sector that has benefited from the pandemic because you've seen a transition from apartments away from common areas and elevators to single-family rental homes. You mean I can rent lower rent per square foot and get a place in the back of that house where I can work from home or homeschool my kids? So Tricon is definitely a winner. They're extremely solid management. These names, Tricon, American Homes for Rent, Invitation Homes, they're all seeing 6, 7, 8% year-over-year rent growth. This is a winner.
In the industrial space, I know a couple of names that you like, WPT and Granite. What do you like about the industrial space, or what don't you like?
Well, we identified about 5 years ago, coined the phrase industrial is a new retail. Industrial is benefiting from all the pain in retail. The move to e-commerce, and now this is old news now, is well-recognized logistics-related space, but this is continuing. It's early in this transition, number one, but because of the pandemic, you've had two new benefits impacting this space. The first is return of manufacturing to North America. Now, this isn't going to happen overnight, but you had an economist from CIBC on a few minutes ago, and I know that, CIBC is predicting 20% of all U.S. imports from China will be manufactured onshore in the United States. Now, that's going to be over time. These are 50-year decisions. So that's the first thing, the return to manufacturing. The second is, when I was in business school, the big operations class focused on the Japanese concept of just-in-time manufacturing. Well, just-in-time manufacturing's done. It's over. Now it's just-in-case manufacturing. You'll still see Nike make shoes in China or Cambodia or Vietnam, but Nike will have redundancy in their supply chain in Western economies and have additional inventories. And so these two additional factors add to e-commerce. We think the sector fundamentals for industrial real estate are going to be solid. Supply is in balance in most markets. And so you can look for good results from Granite REIT, WPT REIT in Canada are a couple of names that we like that are benefiting from this trend.
And as you say, a trend you saw a long time ago, one that some have been on the fence about, although I think we may see the wavering come to an end, is on the office side, the kind of retail-related and office space. We are starting to see subleases now rolling over. What do you think we're going to see there? How serious might that get for some of those players?
It's going to be bad. It's not going to be like the 1990s where you had zero net effective rents, that's for sure. But, this is a sector that was already experiencing a 20-year secular reduction in demand before the pandemic. The lawyers don't have law libraries anymore, right? So we've seen the reduction in demand. Now, when you've had major CEOs from Bank of Montreal, Shopify, Twitter, Facebook, Goldman Sachs, et cetera, come out and say their workforce has worked really well from a work from home or remote environment, their long-term demand for office space is going to be lower. We believe them. We think there's going to be a 10% longer-term reduction in demand, and this is in the context of a spike in supply. So we're supply and demand driven, and we see that metrics, not working really well for office. We think that it's going to be some pain in office.
And would that be a long-term view, or would you wait for some inflection point where office gets attractive enough that you want to get back in?
You can have poor fundamentals, and then it comes down to the heart of your question, valuation. And certainly you saw office REITs, particularly in the U.S., get crushed early in that year, and they had a big, hope trade recovery back in that, great day in November. And so it does come down to valuation. People will still use office. Vision, we can look forward to getting back to our office space. So I'm not saying office is a dodo bird. If the valuations get aligned, we'll be back in office for sure.
And there is one way to play European residential REIT, which is associated with a Canadian name, Cap REIT. What do you get when you look at this one? What's attractive about it?
Yeah, Cap REIT has done an incredible job of sponsoring actually two European REITs. The one you mentioned, European Residential REIT, these are apartments focused in the Netherlands, listed on Toronto. The Netherlands is the most densely populated country in Europe, and there's a massive housing shortage. And there's a very complex rent regime, their rent regulation regime, and Cap REIT has just excelled in a rent regime in Canada since they went public in 1995. So these are very, very compelling returns that they're enjoying there. The stock is cheap. I think the consensus view in net asset value is around $5. So, here you can buy apartments at a discount. That's what we do at Vision. The other one is IRES. Now, this isn't listed in Canada, but it's equally interesting. The only apartment REIT focused in Dublin. Again, that's trading around 1.5 euros. We think it's worth 2. Very high quality, and Cap REIT has sponsored both of them. So you have the confidence and support of a world-class operator in apartments managing your investment in both of these REITs.
Jeff, always great to have your thoughts. Appreciate your time. Jeff Olin, Vision Capital.